Joining us for more insight on that issue is Rick Bloom from Bloom Advisors. Rick, thank you for joining us today.
It's a privilege to be here. Thanks for having me.
Yeah, happy to have you on to unpack this issue because this was a bit of a Monday surprise when this news dropped that the markets opened and the Dow took a tumble, Japanese markets took a tumble. That impacted everything sort of down the line. Give us the basic overview. What should people know about what happened in the stock market and how it may affect them today?
Well, if you talk to 10 economists or 10 market watchers, they'll give you 20 different reasons why the market tanked. I mean, whether it's the fear, because the employment numbers, the fear that we're going to go into a recession, that the fear that earnings from corporations haven't been as strong as is hoped. There's a lot of different reasons, including what's happening just around the world. But what I tell investors is that you can't get caught up in the day-to-day volatility in the market. Downturns in the market are normal. They happen all the time. Volatility is just a fact of life for investors. So what I always tell investors is to take a step back and don't do anything in a panic mode. I always feel that when investors make decisions based upon fear or greed, they always make the wrong decisions. Investors at this point in time, the market's a little out of whack. They shouldn't be doing anything with their portfolio. Sometimes doing nothing really is the best strategy to follow.
We're already seeing the day after that massive dip. The Dow was down 1,000 points. S&P 500 was down and had its worst day since 2022. But you come back the next day and already Japanese markets jumped by 10%. Dow, S&P 500 futures already went up. So what advice do you have for investors in how they should approach the ebbs and flows? Because like you said, worry can be a good thing. You want to be vigilant, but at the same time, you can make a lot of mistakes. So how do you navigate that on the day-to-day, month-to-month, year-to-year?
I think the key is for investors to focus on things that they can control, like their goals and objectives. It's important for the average investor to have a diversified portfolio, risk spread out in a variety of different investments, so that when we go through these crazy times, their portfolio is not as affected. The problem that we have is most people treat the stock market like a casino. It's gambling. And they look at buying winners and selling losers. Well, that strategy generally fails, because if you buy winners, then you're talking about buying high. And if you sell losers, that means you're selling low. Buying high and selling low is absolutely not going to grow your portfolio. On the other hand, buying low and selling high, that's a good strategy. So I say investors, especially ones that's sitting on cash on the sidelines, ought to look for some opportunities to take advantage of this down market. But I think too many people try to outsmart the market and try to time it, and you just can't do it. Warren Buffett once said, it's not timing the market that makes someone successful, it's time in the market. And I think people need to do that, need to be aware of that. And remember, you don't have to do anything in these type of difficult times, especially if you have diversified portfolios. That's what they're built for, is to get you through this volatile time.
Rick Bloom is with us, a CPA, joining us from Bloom Advisors. More information on them and get in contact with Rick, bloomadvisors.com. Rick, in terms of some of the motivations or some of the factors behind that dip that happened on August 5th, included some volatility in the market. Of course, there's the potential for recession that's been out in the conversation as well, and of course the job numbers also impacting the stock market on that day. How may those factors behind the stock market dip have more of an impact on our local economy than the dip itself?
I believe the two you mentioned, fear of a recession and the employment numbers, really go hand in hand. But I always tell people about recessions. Not all recessions are the same. You go back to 2020 in March, when we were hit with the COVID, we went into a recession, and that recession was gone before most people knew about it. And by the end of the year, we were in record territory again. And so it's not the fact that we go into recessions. The question is how deep of a recession we'll be in and how long will it take to get out of it. And one thing that surprises investors, investors make money even during recessions if they're patient and if they follow a strategy. You can make money even during a recession. So I wouldn't be so fearful about a recession. Obviously, I don't want a recession, and I certainly don't want a long one. But we've been talking about recession for over 2 years right now, and it still hasn't happened.
Yeah, there's the ebbs and the flows in the market. There's those downturns that people often have a bit of a panic for, and then when things start to rise back up, they often don't notice, or they'll be excited about it, and they'll make decisions in that way. But it's about some calm and some strategy as well. So Rick, as we think about that, and before I let you go, at this time, given the state of the market, what's just happened, the lessons we've learned, what steps forward can people in Greater West Bloomfield take to protect their portfolio and to enhance their portfolio, perhaps going forward?
Right. I think one thing everyone should do is to make sure they have an emergency fund of money. I think that protects portfolios because people fear that they're going to lose all their money and they won't be able to take money out. Everyone should have at least 3 to 6 months of living expenses that they keep liquid. It's not a great investment to keep it in short-term investments, CDs, but what that money does, it protects your portfolio. And the other thing, I'd be looking at some buying opportunities. For those of you that are sitting on cash, the market's on sale. Why wouldn't you want to go shopping? You know, in any other area, when stores have sales, people rush to the stores. But the stock market's totally different. When the market's on sale, people rush away from it, and they shouldn't. They should take this opportunity. And another thing people should look at doing is whether they should convert some additional money from their traditional IRA to a Roth IRA. They can convert some money, they'll pay lower taxes, and that money turns around and grows tax-free. So I say investors should look at taking opportunities, and that's either to buy, but also to look at converting additional IRA money from traditional to a Roth IRA.
Well, Rick, we appreciate your advice and your insight into this issue. It certainly wasn't a great start to the week for a lot of people after hearing that news, but glad to have a little bit of that clarified with your expertise today.
Thanks so much for having me. It's a privilege to be here.